Today is Monday, January 13th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, and Alan Bush, ADMIS Senior Financial Economist, and Mark Bowman, ADMIS Senior Market Analyst. Starting with the financials this morning, Alan, after last week's employment report, it seems the Fed may not be lowering rates as soon as expected. Can you comment on the Fed Reserve policy and how this may affect financial futures markets?
Yes, that is exactly right. That employment report from last week had a very major impact on the outlook for Fed policy. So the dominant fundamental affecting all of the financial futures markets is the belief that the Fed will slow the pace of interest rate cuts this year. Late last year, there was a consensus view that the Fed could cut interest rates 4 times by 25 basis points each. However, markets are now predicting only 27 basis points in rate cuts in 2025. So that's basically just one rate cut for the whole year. So it does look like the Fed will keep its policy unchanged at the January meeting, the March meeting, the May meeting, but there is one rate cut likely to be announced at the June meeting. So a Fed that is likely to be slow to become more accommodative remains supportive to the US dollar, which today advanced to the highest level since November of 2022. At the same time that the Fed is likely to be less accommodative, the European Central Bank and the Bank of England will probably become more accommodative. So that is a recipe for continued gains for the dollar index and lower prices for the euro currency and the pound. So this is the place to be in the financial futures markets: long dollar, short pound, short euro. As far as stock index futures, a less accommodative Fed is putting pressure on stock index futures, and it appears that a stronger economy and probably better corporate earnings may only mitigate the negative influence of the bearish interest rate influence. So stock index futures, don't see a lot of upside near term. Interest rate futures market, same thing, a less accommodative Fed likely to put pressure on the interest rate futures market, especially the bonds.
And Alan, any significant reports the traders will be looking to the rest of the week?
Okay, yes, there are. Tuesday, we'll have the December Producer Price Index, and that's expected to be up 0.3%. And on Wednesday, the December Consumer Price Index expected to be also up 0.3%. And then Thursday, December retail sales predicted to be up 0.5%.
Thanks, Alan. Shifting to the grain markets, Mark, we saw a USDA report last Friday. What jumped out as the biggest surprise to you?
Well, to me, the biggest surprises were the fact that both U.S. corn and soybean production from last year's harvest came in well below the range of pre-report expectations. Corn production was slashed another 276 million bushels to just under 14.9 billion. That was some 230 million below expectations. We still have a record yield of 179.3 bushels per acre, but that was still down about 4 bushels per acre from November and among the largest drops ever in the month of January. U.S. ending stocks fell to 1.54 billion bushels. Well, not particularly tight. They're well below the 2 billion bushels that was forecast last fall. It gives us much less wiggle room for any production problems in South America this growing season. And when you look at the global stock situation, you factor out China at 87 million metric tons. Global supplies are the lowest now in 12 years, going back to the last major drought here in the U.S. in 2012. And on a stocks-to-use ratio at under 10%, 9.4%, it's among the lowest now in the last 20 years of data that I have readily available. So I would not be shocked at all to see corn prices have a 5 handle in front of it here before much longer. Similar story in beans with production. That was down another 95 million bushels to 4.366 billion. U.S. ending stocks at 380 million bushels. Not tight, but still, a far cry from the 550 million that was projected last October. Global stocks still a record high at 128 million metric tons, but still, well below the 135 that they were suggesting last fall. The USDA left the South American production forecasts unchanged for now, apparently just kicking that can down the road a month to see how this hot, dry stretch that we've been experiencing now in central Argentina, how that pans out here over the next month or so. I do think that that follow-up production in Argentina and Brazil will likely come in pretty close to the current estimate of 221 million metric tons, maybe up a little bit in Argentina, or excuse me, up a little bit in Brazil, down in Argentina. Right now, March beans, it's 90 cents off the lows we had just a month ago. And I'm guessing we'll run into some pretty stiff resistance near that, November high that's near the 1050 level. We've had several analysts expecting beans at $9 or below. I think that on increased trade tensions with China, but I think that's off the table now with the U.S. stocks much tighter than expected given the lower production.
Thanks, Mark. Mark Bowman, what key reports are coming up this week in the soft markets?
Well, first off, in the sugar market, we have the Unica update. That's an update on Brazil center-south sugar production. That is a bi-monthly update, and this one will be for the second half of December. These reports usually come just ahead of mid-month and just ahead of the end of the month, so that would put this report expected to come out tomorrow, possibly Wednesday. The last report showed that as of December 16th, cumulative production was running 5.1% below a year ago, while cumulative ethanol production was running 3.3% higher. And sugar's share of cane crush by then had fallen to 36%, as ethanol share had risen to 64% for that period. So there's been quite a reversal. Now, the trade, we've been expecting production to fall off this time of year as the rainy season sets in, because that slows the ability to harvest and to crush. So it would not be surprised to see a sharp drop off. And the recent rains have improved the outlook for 2025. Other big report is in cocoa. We have quarterly grind data due out on Thursday, and this is for the fourth quarter grind numbers for Europe, North America, and Asia, all released by the different industry associations for those regions. In the third quarter, Europe's grind was down 3.3% from a year ago, and their 12-month total was down 1%. And Asia's grind was up 2.6% from a year ago in the third quarter, and their 12-month total was down 2%. And the North American grind was up 11.6% from a year ago, but their 12-month total was up 3.5%. So this was kind of a surprising trend considering how high prices have been. But much of this may have been due to the fact that they were already booked on the cocoa needs. And so with the more recent rally in prices coming in, it may be we could see a bigger drop from year ago levels in the report on Thursday. Nearby prices for cocoa went from 77.22 as of September 30th, the end of the third quarter, and now to 11,675 on December 31st. So that was a gain of almost $4,000 a ton, or 51% during the course of the quarter. So we would expect to see possibly a drop and grind from a year ago in Thursday's updates.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.